Hey guys, if you're considering buying a vehicle in 2023 and would like to deduct its costs, in this video I will show you two different strategies to deduct the cost of your next vehicle purchase. But before I get started, if you want to learn more about properly structuring all of your real estate investments and protecting your assets, you can register for our free tax and asset protection live event at the link below. Now, let's start talking about deducting your vehicle. Okay, so when it comes to deducting vehicles, there's two ways in which people will typically write off a vehicle purchase. One is going to be under Section 179, where they're going to deduct the cost of the vehicle or a portion thereof. And the second one is going to be a mileage expense. Now, I'm going to cover both of those, but we're first going to start with the Section 179. So what are some of the base rules when it comes to Section 179 in order to write off the cost of a vehicle? First off, the vehicle cost itself can exceed your business income. So what I mean by that, if you're making $8,000 a year in business income, let's say it's a small little side gig where you take photos of weddings and you only do 2 weddings a year. Now you want to go out and you want to buy a Porsche that's going to run you $90,000. You ain't deducting more than $8K on that purchase price because they're going to limit it to your company's income or your business's income. The second aspect about writing off a vehicle under Section 179 is that the vehicle itself, 50% of its use must be in the business. So in my example of someone taking pictures of weddings, if they're only driving that vehicle 10% of the time for business activity, then it doesn't even qualify and you won't be able to write it off. Now the question is, how much of a vehicle can I write off under my business using Section 179? Well, in order to determine that, you have to look at the type of vehicle. And the IRS, or the Internal Revenue Code, breaks it up into two different categories. One is what we call small vehicles. These are vehicles that weigh under 6,000 pounds gross vehicle weight. Now, if you have a vehicle that's under 6,000 pounds, you're able to write it off, but you're limited on how much you can write off in the first year. The Internal Revenue Code limits you to about $11,160 in the first year you put that vehicle into service. So if I bought a $24,000 vehicle and it's under 6,000 pounds, which a lot of cars fall under that, say it was a Honda Accord, then I would only be able to write off in the first year $11,160 of that purchase. Now that assumes that you use it 100% of the time for your business. Now if you're only using it, say, 60% of the time for business, then the deduction is going to be reduced proportionately. So for the example, let's say I'm a florist and I go out and I purchase a van and I'm going to use it 50% of the time for delivering flowers and the other 50% of the time I'm running my kids to football practice. Well, in that case, only 50% of that vehicle, or of the $11,000, would be deductible to me. And so you get capped out at that rate. Now the next thing we look at when it comes to the vehicle size is what we determine to be the heavy vehicles. And those are vehicles that weigh over 6,000 pounds. So if you buy a vehicle that weighs over 6,000 pounds, you're going to get a deduction for up to over $28,900 on the purchase of that vehicle. Now, if you're wondering what vehicles qualify for heavy vehicles, well, of course, it's going to be many trucks. In fact, if you look in the show notes, I have put forth an entire list of vehicles, some of them, what we would say, luxury vehicles that do qualify for this deduction. So if you're thinking about getting an Audi Q7 or a BMW X6, guess what? They weigh over 6,000 pounds and they will qualify for this deduction. So you'll be able to write up $28,900 on these heavy vehicles. So when you're considering your next vehicle, you may want to go heavy rather than light. Open up the door, look on the inside. It'll have the gross vehicle weight right inside of the door frame. Now you're probably wondering, hey, Clint said I could write off my vehicle. It sounds like I can't write off the entire cost of that vehicle. Well, guess what? You can. And the reason why you're able to do it is because right now we have what is called bonus depreciation. And bonus depreciation is still in effect. And what you'll do with your vehicle under Section 179 is you will bonus out the entire cost of the vehicle this year up to 80%. So if I bought a heavy vehicle that cost me $75,000, and ordinarily I can only write off the $28,900 of it in a normal year. Well, because we have bonus depreciation that is now available to us under the Tax and Jobs Cut Act, I'll be able to take 80% of that and write it off in year one. So bonus depreciation applies to small vehicles and heavy vehicles, and it's something you definitely want to look at if you're writing off your car. Now, what happens if you fall below 50% use for your business vehicle? Well, in that case, then you're going to have to recognize its value back into income. And I see this a lot with people. I was just talking to someone the other day about this. I told them, I said, if you go out and you buy a car or a vehicle under the name of your business and you're writing it off under bonus depreciation, section 179, you deduct the cost of that car, and you're no longer using it 100% of the time, and you're using it only 40% of the time for business, and you're using it 60% of the time for personal, then you're going to have to recognize back into income that 60% use. So that is a problem that can happen with vehicles in which you run into that you're no longer using it 50% or more on business-related activities. One of the things to keep in mind as well when you're thinking about business vehicles is that I would always tell you that in case of audit, keep a separate vehicle in your personal name. So in this example, the client that I was referring to, he purchased 2 vehicles at the end of 2022. And the reason why he did that, they were both heavy vehicles, both what we would call luxury vehicles. He's section 179 and bonus depreciation on these vehicles to write them off to reduce his taxes. Now, he told me he's going to use them for at least 50% of the time in his business. I said, great, do that. But here's something to consider. Just in case you aren't, I would highly recommend that you have a separate vehicle on the side. So if you're ever audited and someone challenges that use, you can show you have another vehicle that you're driving around with. Because you can see what would occur here is that if he gets audited by the IRS, they're going to say, well, what do you drive to go to the grocery store? What do you drive to take your kids to the football practice? And the only vehicles you have are your company vehicles. They're going to say you're using them personal. And then they're going to start looking at how much of the deduction you took. Because if you claim you use them 100% of the time for business, but you have no personal vehicle, they're not going to buy that. So keep that in mind when you're writing off your business vehicle. Now, the second prong or the second test you can use to write off your business vehicle is the mileage deduction. So that is where you drive your personal vehicle on business-related activity. Right now, the current mileage deduction is 65.5 cents. So in order to qualify for this, it doesn't matter what the size of the vehicle is, how much it's driven for business, all you do is keep track of all your business miles, and you have to keep a log. If you don't keep a log, if you get audited, they will disallow this. I've seen it happen in many different court cases, tax court cases, where real estate investors have claimed business mileage deductions for the use of their personal vehicles, but they could not substantiate it with a log. And the rule here with the logs is that the log be kept contemporaneous with the actual mileage. So, at least on a day or weekly or daily basis, you should be writing down where you went, where you started from, where you ended from, and keep a mileage log and what the business purpose was in case you get audited. So the mileage log, I think, is great for individuals, again, where you're not going to meet the 100% test. You may want to look at that because many times at 65.5 cents, if you drove, say, 10,000 miles, that's $6,500 your business can pay you, and it's tax deductible to your business if it was a corporation. If it's a flow-through entity, it's just a deduction to the income that you're generating from that. You don't have to pay taxes on it. So the mileage deduction, that's another option as well. If you want to learn more about the various tax deductions that are available for real estate investors beyond just writing off the cost of your business vehicle, I'd like to invite you to our tax and asset protection event. It's a live event that my partner Toby and I, Toby Mathis, teach, where we go into business entities. I'm going to teach you about LLCs, land trusts, wholesale trusts, corporations, limited partnerships, how to use them in various strategies of real estate investing, buy and hold, flip, commercial, wholesaling, residential assisted living, and then we're going to come in and blow you away on all the various tax deductions that are available to you as a small business owner, as a real estate investor. More importantly, you got questions, we've got answers. We're actually going to bring attorneys and tax strategists to this event. They'll be there to answer all your questions live. Tremendous amount of information. People who attend this event always say the same thing. The best 8 hours they ever spent on a Saturday.